Today on this very special show with me, I have a very special guest, Shweta Rajani Head, Mutual Fund, Anand Rathi Wealth. Shweta, hi, good evening. Welcome to the show and wish you a very, very happy Holi. And a very important task at hand for you today, because you need to guide our viewers, explain them the concept of different colors, because it's Holi, what is each and every color, significance of each and every color, and how in your portfolio these colors can add value and maybe take you away from this entire environment of volatility and the trajectory which is very threatening for the new investors especially. How can they design a portfolio where they are away from the negativity, have the risk management in place? So how would you like to begin?
Absolutely. Firstly, good evening and happy Holi to all our viewers. And, just like we say, when we talk about Holi, it is also about letting go of the evil, having a fresh start. So I hope everyone, we're also going to enter the new financial year. Everyone has a fresh start to their portfolios, the way they look at it.
Right. Right. All right. So let's begin. And okay. So we are going to be talking about a time frame, which is from this Holi to next Holi, right? What should be your strategies? Because see, in terms of strategies, a lot depends on your risk profile, a lot depends on your market cap exposure, a lot depends on the time frame that you're looking to be invested in the market. But having said that, beginning of this year, we've had the conversations where we said that it's not a year where you should be focusing just on returns. Okay, you should not be expecting the returns that you saw in the last few years. Also, this year is also going to be having moderate expectation as far as return is concerned, and more about ensuring that you have enough stability in your portfolio. How can one go about this? Is this a year of SIPs? Is this going to be a year only of lump sums from this Holi till next Holi?
Absolutely. So, since we are talking about risk management, stability in the portfolio, it becomes that much so important that you should have a disciplined approach towards investing, and that can come in, if you're doing your SIPs on a regular basis. So definitely it is a year of SIP for sure. And if you have in pockets, at times, opportunities like the current opportunity that we are sitting on, where the markets are sitting at almost 15% below the peak levels that we've seen, then that much amount should be allowed, whenever you have some lump sum. So lump sum on dips and a regular SIP should be the strategy that one should adopt for, I would say, the next financial year, from this Holi to the next Holi.
Okay, let's deep dive into the kind of colors one really need to add in their portfolio. See, basic thumb rule to have the portfolio in place or to design the portfolio is you need to set your financial goals, diversify your investment, because that's going to be a very crucial strategy. But within that also you should be looking at what kind of market cap. We saw the AMFI numbers coming up, Shweta, where we saw month-on-month numbers for mid cap and small cap have come down to 34 to 35%. That's the inflow which has gone down. But we are seeing strong inflows in flexi cap, 11th month straight. So how to take up all these rules and have a portfolio designed for 1 year time frame?
Absolutely. You spoke about the flows that are being that have slightly reduced in the mid and the small cap space. People are shifting towards flexi because that's a mindset where somebody is leaving the decision to the fund manager, because the flexi cap category is where the fund manager is going to do the market cap mix for you. Also, at this point of time, it is a large cap heavy category. So given the the entire valuation stress on the mid small cap segment, where earnings have also been a little subdued, this is natural where the flows could have seen a slight dip. Now, for the coming 1 year, I would say in terms of a market cap strategy, what one should adopt is still have a portfolio which is around 60% or large cap and 40, which is split equally between a mid and small cap, can still be a good portfolio combination to have. Why am I saying that is because after the 15 to 20% fall we've seen across large, mid, small, valuations have become fairly reasonable. Earnings have been subdued at this in this year for the small cap segment, not so much for the mid cap segment. And therefore, next year, when the base effect kicks in and you see slight improvement in the earnings coming in, having that 40%, mid small allocation may still be a good blend to have in the portfolio. So yes, sticking to categories like multi cap, flexi cap, large and mid cap in the portfolio should be the right approach to have. That's one, strategic approach to have in terms of market cap. Second, I would say spread out your portfolio across funds. Don't be concentrated by having 15-20% allocation to a single fund. So having a good mix of diversified 8-10 funds in your portfolio would be another risk management strategy that one should have in the portfolio.
Also, Shweta, if I want to talk about having combinations in one's portfolio, how much of an exposure to equity? I mean, one can directly have a multi-asset allocation fund. We've been speaking to a lot of fund houses, so FlexiCap, multi-asset allocation, and BAF have been, few categories where a lot of inflow or interest has been picking up. But then, it's also time when you want to have a growth-based portfolio at the same time, because if you're someone who just made your investments 2 to 3 years back, you still have that time frame where you want your investments to grow. So what kind of combination works here, Shweta?
See, one thing that is important to note is every individual's asset allocation requirement could be different. And that would depend on what your risk-taking appetite is, what your investment horizon is. And therefore, going in for a BAF or a multi-asset fund where the fund manager is following one size fits all approach may not be suitable for every investor. And that is why I strongly recommend everyone that once you've decided what your goal is, what is the tenor of your investment, how much risk are you willing to take, each individual at your overall investment level should decide how much equity, how much debt, how much commodity you want in the portfolio. Once you've decided that, so, I could have one investor who's wanting to have 60% equity versus another investor, wanting to have a 70% equity. Once that has been decided separately, parking that in equity funds and debt funds or debt other alternatives would be a better approach to have in my mind. And that will do the same job as what a BAF or a multi-asset fund is doing for me, as long as you're looking at it at a portfolio level and not cutting out as one scheme which is doing asset allocation for you and the rest of the portfolio not having a asset allocation decision made already.